Thank you, Mr. Chairman. With that, it is my great pleasure to introduce Austin Campbell, who hopefully is able, who's, I believe, able to speak and present. And so, Austin, if you're here and want to see you, hello. If you want to pull up your presentation, that would be great while I give you a quick introduction. So Austin Campbell is the founder and managing partner at Zero Knowledge Consulting, as well as professor at Columbia Business School in New York. Previously, Mr. Campbell spent 2 decades at traditional financial institutions trading, I'm quoting him now, profoundly weird financial instruments. And then most recently, he served as the chief risk officer and head of portfolio management at Paxos, the stablecoin issuer behind their own USDP token, as well as PayPal's PYUSD offering. So I've asked Austin to join today because we've had questions along the way of how stable tokens can help both community banks and credit unions in the state. He certainly has a lot of experience, and we're going to hear about it all now. So, Mr. Campbell, if you wouldn't mind giving your own introduction rather than one that I copied and pasted off of a website or LinkedIn. Perhaps briefly your overall thoughts on the stable token industry and where it's going, and then thoughts on community banks, credit unions, and we'll leave about 10 minutes of a 30-minute conversation for Q&A from the commission. So we'll look to have you wrapped up, and then we'll let you get down to class. So, Mr. Campbell, with that being said, I will let you take it away.
Professor, welcome.
Thank you very much, and thank you for having me. I apologize to everybody I can't be out there in person, but I unfortunately have to be teaching a class literally in a couple of hours, so I have to be boots on the ground here today, so apologies for that. All right, so I put together a brief agenda for today. I am fully aware we want to leave time for questions, so we will get there in timely fashion. And I'm going to walk through all of these points, as I would start with 2 general comments before I even get into background. One, I think the interconnection between stablecoins and banks is one of the most important and yet most misunderstood parts of the public discourse around stablecoins in general. And I would tell you that complication exists beyond just the United States. I have spoken with multiple global regulators on this point, and understanding and getting to the heart of those issues probably is the #1 driver of people who will succeed versus fail, specifically in the fiat-backed stablecoin space. And I would urge everybody here, my comments today largely apply to those. I would not generalize to things like, say, Athena, which Anthony mentioned earlier, or to things like perhaps DAI, certainly not to like the ill-fated space of algorithmic stablecoins. So I'm focusing very much on, dollar-backed with dollar reserves stablecoins. All right, so who is this guy and why should any of you listen to me? So I am originally a banker. I spent more than a decade between JP Morgan and Citi running fixed income trading desks. And most of my work involved a combination of looking at bank capital positions and stability and structure and business model. And the other part was retirement markets and cash stability products there. So if I were to tell you about a traditional financial product and explain it in the following way, this would probably sound very familiar to the commission, which is imagine a large and diversified portfolio of bonds that the participants in this pool need to be able to trade in and out of at a fixed stable value. Well, that sounds a lot like a stable coin. It's also something called stable value. If you ever look at a 401k, 403b, et cetera, that's almost $1 trillion industry now. And I had to help put that back together post the financial crisis at JP Morgan. I've also been in crypto for a while. I was at NYDIG, if anybody is familiar with them. It's one of the very Bitcoin-focused firms in the space. And as Anthony mentioned, I was at Paxos. We were the 3rd largest stablecoin issuer in the world at the time, behind only Circle and Tether. And as a result, my fingerprints are all over PayPal's stablecoin. I built the supermajority of the backend for that. Academically, I teach at Columbia Business School, where I have to be later today, and focus on market structure payments, et cetera. So the interesting stuff for all of you. On the policy front, I have testified as an expert in front of House Financial Services Committee, so I have had to field questions from Tom Emmer. And I speak at many of the regulatory conferences. I've spoken at multiple Federal Reserve events, the Japan Financial Services Authority, Bank of Korea, et cetera, down the list. Some of them even read my Twitter, which is quite a lift when you understand what that means for regulators. But what I would say is I have my finger decently on the pulse of what's going on, not just nationally in the United States, but internationally with regard to this space. And I try to hold myself out for people just as an expert, because my agenda is just getting things right. So in that spirit, the last thing I'll say here is, I often say this in my class. I say it anywhere I'm talking. Any and all questions are welcome. This space moves so fast that even though I've been in it a while, I'm confused on a daily basis by things that I see. So if you are too, that's normal and probably just means you're paying attention. So feel free. All right. Where are we with stablecoins globally? One of the important threads here, this is zooming out just from locally the United States, is that it is inevitable that we are going to have to deal with these things, making contact with the banking system one way or another. Certainly nothing that Wyoming does is going to stop this. Quite frankly, nothing that the United States does appears to be capable of stopping this currently. It may be able to change the shape of it slightly, but you are influencing a trend that is going to continue whether we want it to or not. For now, as a benchmark here, Tether on a per employee basis is the single most profitable company in the world. They made something like $60 million per employee last year, and that number continues to go up, not down. The demand for specifically US dollar stablecoins globally is tremendous. And when you understand the local concerns that are driving this, you can see why it continues. Because if you go somewhere like Nigeria or South Africa or Venezuela or Malaysia, where people historically have only really had the option of keeping money in local systems or physical goods, and now they have the ability to opt into the US dollar system at scale on a blockchain and preserve their property rights, people choose to do so. As a benchmark for that, when I was at Paxos, we estimated that roughly 95% of the holders of BUSD, which at the time was over a $20 billion stablecoin, were non-US persons. And the only country where I'm absolutely certain nobody owned the stablecoin was North Korea. Basically, if you have the internet, these things are coming. Two, and another very important point for banks, credit unions in Wyoming, is the accessibility of this ecosystem. I explain this many times to people where the current system is largely a monopoly or oligopoly, depending on which part of it you're running around in. I can tell you as somebody who is at JP Morgan, man, do the big banks take advantage of that, and they know what's going on there. But a blockchain, which is an open access system, allows people to start circumventing that and interoperating with each other in ways that were simply not previously possible. This is another reason these things are coming. Many small players want them and will work with each other through them regardless of what others think. The last part is we're still quite early. Like if you study the history of financial markets transformation, this plays out over many decades. Just the shift from paper tickets to electronic trading in the United States was a long ordeal, and there are still probably a handful of backwater markets that are largely running on paper, like some of the elements of reinsurance. It takes a long time. And what that means, globally, as I look around, is we're still very early. As Anthony referenced earlier, the HKMA, who's a pretty sophisticated regulator, is still just now booting up their stablecoin sandbox. The MAS, who may have been the global leader in this space, is still in the early stages of Project Guardian. So I would tell the state of Wyoming, your time is very much now. Right? Entering at this moment will put you at the forefront, allow you to get your hands on things that allow you to experiment in safe ways, as opposed to trying to chase what has happened if you wait 5, 10, 15 years down the road. And when I say these are inevitable, I'm really not joking here. So what we are looking at is a chart of annual settlement volume of Bitcoin and stablecoins versus other financial systems. There are two important things that show up on this chart. Stablecoins essentially did not exist on here until about 2016, which is when Tether got like on chain in a proper way. And in that time from there to now, it has basically come almost to parity with Visa in terms of global settlement annually. And that number is going to continue to go upwards. We had a slight downtick in 2023, but again, I emphasize slight, compared to a crypto ecosystem that had a much larger downtick. And another important point on that is you will see there is increasing decorrelation from Bitcoin and crypto trading volumes. People are using stablecoins to pay for things. They are buying sandwiches, they are buying pizzas, they are buying cars. This is no longer, hey, we're just, YOLOing around and trading tokens with each other. And the volumes are growing. They're already larger than PayPal, which, may be informative as to why PayPal thought about launching their own stablecoin. So now we get to one of the interesting parts of this, which is what exactly is going to happen with banks as you interact with stablecoins. I would say most people, I think, take the view in the traditional banking sector that stablecoins are competition and that they are worried about deposits being cannibalized and they are worried about their business model being disrupted by stablecoins. And I will tell you, I think that view is half right, but also half wrong, especially as somebody who's been on both the bank side and managed the bank relationships as a stablecoin issuer. So the number one thing that's going to happen here with regard to smaller banks is that stablecoins properly built, something like the Wyoming stable token is going to be a great example of this. The things that come out of the NYDFS that were referenced earlier would be another good example, are highly diversifying to your deposit profile. If you think of most small and regional banks in the United States and you look at their deposit base, excluding a few specialists, they're largely relatively local in terms of the sourcing of the deposits. It is rarely the case that, say, a bank in Arkansas is handling massive deposits out of, I don't know, Japan. And at the same time, they're usually pretty related to local activities. So this creates two problems for people. One, you have a lot of correlation between local banks, which may not be ideal in the long term for a stable system. The other part is that a lot of these deposits behave pretty similarly to each other. Now, that's nice if you're like a banker trying to do deposit models and capital stability, because I kind of know what's going on, but it's actually not ideal from the perspective of the bank. You would prefer some diversity in that so they don't go all one way on you at the same time, as we saw happen to some banks last year that ended in tragic fashion. Now, the stablecoin deposits that you end up with tend to have a very different economic profile than the deposits that you're going to end up with through, call it, more traditional people who are just like running a local business or something of the sort. And what that means is they're faster money. So it's dangerous to engage in maturity transformation with this money. You would not want to take your stablecoin deposits and go lend against 30-year mortgages or something like that. It's just going to be a disaster at some point if there's a large drawdown. But the flip side of the coin is the economic concerns of those people are largely around using a system for payments and settlement. It is less around local economic concerns. And what that means is the banks that have been successful in this space essentially take in deposits from the stablecoins, back them with relatively conservative instruments from a capital perspective. So we're talking here like T-bills, agency debt, overnight reverse repos secured by government securities, things that quite honestly look a little bit like Fidelity's government money market fund and maybe a little bit more risky than that, but not hugely more risky than that if you look outside of it. And then you end up with a deposit profile where your bank now starts to look like part of it is doing your traditional lending business, but part of it looks more like a fee generating enterprise where you are essentially managing assets on behalf of these people, collecting a cut of that for yourself and facilitating payments. It allows your bank to move from something that is very interest rate exposed to something that is much less interest rate exposed if you manage these deposits properly. Now, contra, if you manage them improperly, you're going to get yourself into a lot of trouble. So one of the things that I would say here is most important for the commission and for Wyoming in general is understanding the profile of these deposits and what they do to the business model and how they transform things. Which brings me to my second point, which is payments. If you look at the United States payment system, it is largely an oligopoly. And in the areas where it's not an oligopoly, it is largely government mandated. So most of our settlements volumes in retail is now moving to debit and credit cards. As people know, the usage of checks and physical cash is going down over time pretty significantly. And in the US, we're pretty concentrated in who our people processing payments are, right? Like if you look at the S&P 500, there is a reason that MasterCard and Visa still trade with a pretty hefty multiple compared to sort of your average stock in that index. And that is because they maintain an oligopoly currently. If you go talk to merchants about the fees that they pay for credit cards, about the fees that they pay for payment processing services, it is a constant pain point. And especially in places like retail or low margin goods, where if your profit margin is only a percentage point or two and you're paying a 4% fee, that is a large, large number. Here, if you understand what's going on with the Wyoming stable token as a bank, you understand this is an opportunity to essentially build a, call it localized, maybe, collective payment system that can dramatically undercut those rates and offer instant settlement. That is a massive technological upgrade for merchants. It is a massive change to the structure of the system that turns the margins of people like Visa and MasterCard into an opportunity for all of the banks and credit unions locally. You could build a two-way payment system at scale very quickly on a blockchain as long as everybody has a wallet. It may be the single easiest system created in the history of mankind to build these at scale. And that is part of what is going to start eroding these monopolies and oligopolies. So one of the things that I would emphasize here is the traditional business of banking is changing as we start to change the underlying architecture behind it. When we move to a world where peer-to-peer payments are more possible at higher speeds, at higher volumes, it's not going to mean that everybody wants to manage their own independent self-custodial wallet. Like my mother does not want to do that. She is not technologically savvy enough. She doesn't want to suffer the brain damage. There will be a role for people like banks to do this securely and safely and facilitate across a group for everybody, especially because there will also be times where you don't want to do instant settlement. There is a value to netting. There is a value to batching. There is a value to matching flows. And so here we are going to see radical transformation over the next 20 years in payments. Those who are integrating stablecoins into their current banking system are likely to be some of the biggest winners. The last part I would say is we're experiencing an incentive rebalancing that started really in 2008 and is now continuing all the way through. Which is to say, in the current system, if you look at what's going on under the hood, it is largely that borrowers are being subsidized by those using the system for payments. And one of the things that I often challenge my students with is, can you buy a coffee electronically in the United States without first lending money to a real estate billionaire? Right. And that sounds like a silly question on the front, but if you look at what happens with bank deposits and who holds those bank deposits, it's actually pretty much the case. Like, again, I was at JP Morgan. We had incredible scale, but if you look at what JP Morgan is doing with its balance sheet on the other side of that, it is probably not what people always have in their head when they go and put money in a local bank. This change that is coming to the system is going to rebalance the banking industry. Having self-custodial stablecoins or stablecoins that look essentially like a tokenized version of a government money market fund allows people using the system for payments to not lend money in risky fashion. Again, for banks that embrace that early, you actually end up with a business model that is different. You've reduced the severity of some of your asset liability matching. You have increased what will look like fee income as opposed to risky lending income and smoothed out your profile. You essentially start to look like a miniaturized version of the JP Morgan conglomerate. But it's also important to understand it's going to change the consumer behavior because of that incentive rebalancing. You will probably become disproportionately attractive to businesses that think primarily about payments. You may be a little bit less attractive on the lending side in some cases. And that's neither good nor bad. It's just a thing. And it's a thing that's coming whether people want it to or not. So I'm going to pause there and take a breath on the bank part for everybody in case there's a burning question, and then I'll move on.
Thank you, Professor. Are there questions? Commissioner Wallace, did you have a question?
I probably should, but it's all a little overwhelming. I guess I'm still trying to get my hands around how does a bank integrate the stable token deposits? I mean, is a bank just basically the wallet holder and on behalf of its customers?
So there's two levels to think about that at. I'm going to start with the very simple one, which is a stable token, when created, needs somewhere to put the money, to put it in the simplest terms possible. And there's two ways to put that money into a bank. One is obviously being a depositor at the bank, like, hey, here's $500,000, hold this for me, right? That is one way that you integrate with them. And then banks just need to understand the deposit profile of that token. Another way is that many people want payment services that interact between rails, right? Which is to say, if I want to pay with the stable token for something, but the person on the other end actually doesn't want the stable token, they just want to receive a bank deposit, you need somebody to stand in the middle and perform that transformation. And that person is typically going to be a bank or one of the payments processors. So I would tell you banks in this space serve both as a place to hold the money, if they know how to do so in safe and secure fashion. And they also serve as a bridge, right? Moving between our legacy systems and a blockchain and back. And that is what I mean by it being an exceptional payments opportunity for banks, is those who really understand this and use it well are going to be in good shape. So a great example of that, you know, and it is unfortunate that they've failed, I think, quite frankly, largely due to political pressure, was Silvergate, right? This is a bank that was doing massive volumes of internal settlements and payments through a network like this. And even in their unwind, didn't lose a single dollar for any of the depositors and paid everybody back because they held very safe reserves. And so understanding that business model and being able to build it in a durable, scalable way is one where you could have disproportionately small entities become disproportionately profitable and important because of facilitating for payments in this space as well. Does that answer your question, sir?
I think mostly, yeah. I guess I would also, though, like to ask about, you mentioned these deposits are, you know, banks would need to manage them different because as quickly as they can move. I think one of the biggest concerns of Wyoming community banks is we're still, you know, we still fund our loans the traditional way with our deposits. So if we have all these deposits that could leave in a fraction of a second, you know, how is the local farmer going to know that he can have a annual operating loan from a bank? And how do we know that the money's going to be there to loan it to the farmer?
No, and that is a very good question. And my answer to you is that basically comes down to understanding your deposit model. So to give an example of what I mean, let's say we have a current Wyoming community bank that has, I'm just going to pick a round number because I'm a simple person, $100 million of deposits. And those deposits are largely, exactly as you said, very traditional deposits. They're, you know, used for very traditional banking activities. And let us say that the stable token launches and another 25 million of deposits come in via the stable token. What I would say is the mistake of that bank would be taking that 25 million and just being like, same old, and doing the exact same thing. I would tell them when those 25 million of deposits come in, do not go loan them against mortgages and business activities with long duration and credit risk profiles. Go do something like buy T-bills and short dated agency debt. So if they leave the building, also, you can leave the building very quickly in a deep and liquid market there. If you do that properly, back to your original point, it actually makes life easier for the farmer, because what that means is the bank now has a stream of income that essentially looks like pretty short-term fee income in addition to their traditional lending business. That means the boom and bust in lending has less of an impact on their overall balance sheet, and the bank is both more likely to be there and more likely to lend through both upswings and downswings. It's the value of combining a, call it, stable fee generating business with a risky lending business and getting a profile that is an average of the two rather than one or the other.
So I'll follow up with one more on that. What happens when all those traditional deposits turn into stable token deposits?
Well, I'm going to tell you, I do not think that is actually a thing that will happen. Or if it does, that's going to be a 30 to 50 year process. The reality is the transformation profile of those things is not what people think. Again, having been at Paxos, it was not the case that the money coming into our stable tokens was just a one-for-one transit out of bank deposits. Where you really saw the money coming in, actually, as I said, was largely payments businesses who to some extent had been kind of trying to avoid banks to begin with, and might have been running through like prepaid cards, might have been running through like PayPal, might have been trying to work with processors directly. So that is a substitution effect that actually gained deposits in aggregate. The other part that you run into is you get people moving out of certain kinds of investment products in there, right? Like substituting out of something like a prime money market fund. I would tell you, I think the impact on local bank deposits is less than you think, because somebody using the system in the way that you described for a traditional loan was never there to move around stable tokens or use this for scaled payments in the first place. So they're related, but the substitution effect was less than people would think.
Commissioner, any further follow-up?
I think that's it for now. Thank you.
Okay. And Professor, I have the treasurer here, but before we go there, just a couple of things. One, and I understand what you're suggesting, but presumably over time there'll be some evolution and you would have a balance that you would carry that would be lendable because, you know, that's what banks do. And I guess the question then becomes a regulatory one on allowing gates and that sort of thing.
Yeah, so I would say over time, as this market stabilizes, I agree with you, the speed of these deposits should decrease. Like that is the nature of any relatively new business. You go from small scale, high volatility, evolving over time to greater scale and liquidity, lower volatility. That is a regulatory question along that path. I think that is a many, many year process as we figure it out. And the banks that were early to it will have a long-term competitive advantage as these stabilize and get back into lending. So I think you are correct there, but I'm going to tell you right now, predictions are very hard to make, especially about the future with regard to the timing of those kinds of things. All I can tell you is that the people who get in early will have a durable structural advantage because they'll understand it better and have a better track record than those who are late.
Well, thank you. Treasurer.
Yeah, I guess getting into the potential profitability there for the community banks, I guess, in the transactions and the fee structure, they might anticipate, credit cards at 3 to 4%. And I think our costs are probably going to be somewhere around 30 or 40 basis points, depending on what kind of deals we can make in the long term. So that's a fairly wide margin there. Would that fee structure be somewhere in there where the banks could take off a quarter on every transaction, or 25 basis points or 50 basis points? What's the kind of, I guess, hypothetical scenario we could put together? And then the other thing is going into whether or not we're going to need any changes in our Wyoming statutes to make sure that we can, I guess, do whatever we can in this process to make sure that the community banks actually thrive and can compete with the national banks.
Yeah, so I would say on your first point, the answer to what fees you can charge is simply put what the market will let you get away with. You're going to need to find the balance point of when is it compelling for merchants to incur the brain damage to try to switch, and what kind of payments business can you attract. I would tell you that number is significantly north of just your fees though, right? If you think about the margins I talked about, charging the same price but paying your processor 2% versus 4% will double the profit margin of many businesses. So I would tell you, I think there is a win-win split between people using the system for payments and the banks here. And that is part of why I think I am unusually an optimist for banks in a stablecoin world, because it really allows them to take back control of the payment system, which is a very interesting nuance I think a lot of people have not dug into. To your second point, I would tell you, I think Wyoming is already doing the single most important thing to support community banks, which is to say, if you just run along doing same old, I'm going to be blunt and say I do not see a competitive advantage in the long run for most community banks or credit unions against somebody like a JP Morgan. I will tell you right now, when I was there and I was dealing with the retail bank, they are hammering hard. We have scale. You can get an ATM anywhere in the United States. And by the way, most places outside the United States. Like your money goes anywhere you want, anytime you want, right? But they charge very high fees. Again, a blockchain and interoperability essentially allows all of the Wyoming and maybe Nebraska, maybe Texas, right? Starting to name people who signed on to that brief to interoperate with each other and build the same scale as JP Morgan without every individual institution needing to have that scale. So to be honest, getting your front foot moving and giving them the opportunity to start experimenting in this space is probably the single most important thing you can do, because otherwise you're probably just on a slow decline over time, which is unfortunate.
Thank you. Commissioner Pope, question or?
Not really a question, just an observation that I'm happy to sit with anyone in front of a whiteboard and go over the benefits of an encapsulated payment system using the Wyoming stable token, especially benefits to banks.
Okay, thank you. Commissioner Racines or Commissioner Naves? Nothing?
Questions about it? Thank you.
Okay, Commissioner Wallace.
Sorry, I just, one more that I wanted to follow up on. FedNow, if that works the way they say it's supposed to, wouldn't that eliminate a lot of the need for the stable token? And I know it's the Fed, and I know it takes, the FedNow is not real quick, but I think it might be getting there. We're starting to see a lot more activity with it happening already. So if that does take off, would that eliminate some of the incentives for the stable tokens?
So you are way ahead of some of my points about credit unions here, which is the other part about blockchains that is very important is they are open access platforms, as I said earlier. FedNow, you have to be a Fed member bank. And I don't have to tell Wyoming how grouchy the Fed has been about allowing people to be member banks. I think that is a well-known problem in your part of America. And so one of the nice things about a blockchain is you can plug into it and use it because it is open access. And even if not permissionless, like I do think there's a place in the world for permissioning on blockchains, especially at the token standard level. So I would not call myself a permissionless maximalist. But even then, it will be much easier for a credit union to plug in and use this directly than it is for them to get the same kind of access at the Fed that, again, any of, say, the big four or the custodian banks are going to get. Because, regardless of the Fed opening things up facially, the other question is, can everybody use this system equally at scale and in an effective way? And here, I think having a, call it credibly neutral system that everybody can participate in, one, smooths out a lot of those problems to begin with. And I think that's extremely important for access for various kinds of institutions. Two, importantly, FedNow only moves money. As the world begins to tokenize more things, one of the other things that something like the Wyoming stablecoin solves is the problem of instant settlement. So again, to take myself back in time to like 2008, 2009, if I'm trading with somebody and things are going to settle T+1 or T+2 in the crisis, I'm asking, are they even going to be around to settle? Like it's the eternal, is Lehman going to survive the weekend question. If I have the Wyoming stable token traded against a tokenized security and I can settle it instantly, that is far better than having to wait for T+1 or T+2 at those times. And again, FedNow only moves dollars. It is not sort of interoperable rails to move other types of values. So you have a competitive advantage in the territory you're playing in that they do not.
And I see Commissioner Revelle.
Thank you, Mr. Chairman. Mr. Campbell, if you, just to continue on the point about a private network versus public network, could you share with us your views on the puts and takes of a public network for the Wyoming stable token versus developing our own private network? And perhaps touching on JP Morgan again, they've got their private network, JPM coin. Why are they doing that as opposed to using a public network?
So a couple of points there. One, I think a lot of the discourse focuses on public-private, but I would tell you it is a continuum, not just two binary endpoints, right? If you look at something like Bitcoin, that is almost maximally public, right? Like completely permissionless, anybody can use it. And on the other end, you've correctly identified like JP Morgan's Onyx, right, as a purely internal platform. And a lot of the reason JPM did that internally is they're worried about a lot of the identification, sanctions violation, et cetera things. But additionally, when they're using that to clear like billions of dollars of institutional repo, they do not want retail on there because they're not allowed to do that at all. Like you have a huge suitability problem there. And then the last part is, quite frankly, they have an incentive to try to internalize all of that for, call it personal profit related reasons that may not really align with the vision of the Wyoming Commission. What I would tell you is important is there are things that exist in the middle ground between those two endpoints. So one of them I used to run, which was the NYDFS style stablecoins. So even though they exist on a public blockchain, they are not permissionless. At any time, without knowing somebody else's private keys, I had the ability to freeze our stable tokens in their wallet or seize them back if I chose to do so. And I don't need their permission. I don't need them to want that to happen. In fact, they can very much not want it to happen, and I can do it anyways. So there you have a level of, although it can trade freely, I can interdict it anytime I want to. There are also networks, take something like, say, an Avalanche subnet that would allow me to permission that on the way in. It might be publicly visible. There might be some standards to get in, and then once you get in, you can largely do what you want with it. but that does not need to be a purely permissionless network, much less the token itself. And so one of the things I would urge the commission to think about, and I know I've had this discussion, with Anthony, is what level of permissioning do you want to think about there? As one caution I would give you is whenever you're touching real world reserves, you have a permission token. Because if you have a token on a blockchain and somebody cannot get to the token on the blockchain, they can still go talk to your custodian or banks holding the reserves. So one way or another, I say this many times to many regulators, real world assets equals real world concerns.
Thank you. Director Apollo.
Thank you, Mr. Chairman. Mr. Campbell, thank you for all the great context. I wanted to add one thing and then do a quick gut check. So with FedNow, one of the things you and I have talked about before is the potential for programmable payment. That's not something that exists. Pardon me, programmable payments is not something that exists within the confines of FedNow. However, it's something that's been possible with smart contracts for years at this point. And I do want to point that out, by the time FedNow launches, as blockchain systems get built and become more robust, FedNow will be ossified and old by the time it is widespread. And I always want to make that point because, if it makes sense to leapfrog certain technology, then I would be a proponent of doing that. Secondly, I did ask you for a half an hour of your time, and we are already past that. I know there are students who also want to pick your brain about this topic, so I want to make sure we have a couple more minutes of your time to finish the presentation, then perhaps answer a few more questions from the commission, if that's all right with you.
Yeah, I would say I have, largely in the course of answering these questions, hopped through the majority of what I wanted to say here. So I will stop on this slide to reemphasize these points, which is this is happening whether we want it to or not. It's part of why I've taken so much time to try to understand these things myself. Is, a little bit like the internet, turning it off is probably just not an option. Two, they are actually a powerful tool for local control. This is why I think it aligns with the values of things like credit unions and local banks more than the large bank monopolies that currently exist. Because when people have localized control and interoperability, you can have many people doing things slightly different ways and having more control over their destiny. And I think that's important for the world as a general statement about human rights. And then the last part, things really are composable here. If one of my students wanted to go and build a business that was reliant upon the JP Morgan Chase app from the App Store, I would strongly advise them not to do that because JP Morgan can destroy them at any time they want arbitrarily. That is not how a blockchain works. You really can just plug in and start building things. So the other thing you're engaging in here is Wyoming is the ability to interoperate with developer talent globally, building things that can connect with the Wyoming stable token. Wyoming is, essentially a landlocked state in the middle of the United States, but as soon as you connect to a blockchain this way, that doesn't matter. You are globally accessible to talent that otherwise never would have been able to connect with the local banking system to build things that you can utilize.
Well, thank you, Professor. One question that's been in the back of my mind, we've compared ourselves to Visa and being able to, kind of transact similar sorts of activities. And we've talked about how they have a 3, 4, I think Amex is maybe even higher in that space. They certainly have an amount of goodwill that probably advantages them. What would make it difficult for them to reduce their fees and simply just try to take over business that way? Does that make sense?
It does. And what I would say is you are essentially talking about the canonical problem that is the innovator's dilemma, right? Which is to say, do I cannibalize my own business or do I let somebody else do it? I think what you are going to find typically is they're going to have a number of relatively ossified concerns that make it hard for them to dramatically cut fees to the level they would need to prevent competition. Because if somebody goes from 4 to 3.5 or 3.5 to 3, that's nice, but that's not going from 4 to 1, right? For them to go from 4 to 1, there's no reason they can't do that except for the fact that it'll cut their stock price down to 25% of its current value, and they don't want to do that. So I think you're going to find a lot of them to be trapped. The other part is institutions that large do not move quickly. right? Like getting anything done at JP Morgan was a multi-year process as well. So they are not going to be fast and agile and like laying siege to themselves in that way, just as a matter of how they operate, whether they want to or not.
Terrific. Commissioner Pope.
Mr. Chairman, small comment and possible question as well. With Visa and MasterCard, because of their settlement timing, are they not also advancing cash basically to the retailer or user, and therefore incurring a cost that an automatic instantaneous settlement would not incur?
I mean, so speaking to that myself, I would say that is a complicated question depending on which way the flows are going. But yes, sometimes they are doing that. And this goes back to my point of instantaneous settlement on a blockchain with the Wyoming stablecoin opens up a whole payments ecosystem that for the most part in the US doesn't exist. Though I would raise does exist very successfully elsewhere globally. Like Japan and Korea have had instant payments basically since the early 2000s, and it did not destroy their banking sector.
Very good. Further comments? Professor, we really appreciate your presentation. Thank you, Director, for making sure that he was here. I suspect we may have occasion to have a conversation again, and I would tell you that Wyoming is a beautiful place in the summer when New York may be just a little bit humid and buggy.
As somebody who has spent a couple of summers in Jackson Hole, I can already say I agree with you. So thank you very much. And I really appreciate the opportunity to talk with everybody. I think what you're doing here is, you know, quite frankly, exceptional foresight, and I hope you were successful.
Thank you. Director.
Thank you, Mr. Chairman. Again, thank you, Mr. Campbell. Good luck with class today.
Thank you.
Appreciate your time.